Picture this: a microcap trading at 0.00009. No hype, no volume spike, just a company quietly trying to survive. Today, we are not pitching a stock. We are dissecting a question. What would have to be true for MedX Holdings to ever justify a 70 times outcome? This is a make-money case study in asymmetry.
Most people hear 70 times and they shut their brain off. That is the wrong reaction. The right reaction is to ask what structure would have to change. Not price, not sentiment, structure. Because if structure does not change, this goes to zero and stays there.
And before we go any further, let us be clear. This is not a prediction. This is not a recommendation. Microcaps fail all the time. Illiquidity is real. Dilution is real. Opportunity cost is real. The only reason to study this is to sharpen how you think about asymmetric risk.
Exactly. In this episode, success does not need to happen for the episode to be valid. Failure does not invalidate the work. We are stress testing a framework. We are asking what must happen in the next 12 months and over 5 years for a fragile business to become a small but durable platform.
And we will be explicit about sizing. This loves at 1%, not more. You earn the right to scale only if execution proves itself. If you are looking for comfort, this is the wrong episode. If you are looking for clarity, stay with us.
I am joining from Austin. I have spent the week reviewing failure paths in franchised retail and cannabis-adjacent businesses. Most do not break because of one big mistake. They break because small promises quietly stop compounding. That is what I'll be watching for today.
I am in New York. I've been working on asymmetric allocation math and how right-tail outcomes distort intuition. This episode is about slowing that intuition down.
I am in San Francisco. I have been mapping where markets misprice survival. Sometimes that mispricing creates opportunity. Most of the time it creates traps. Let us figure out which this could be.
Subscribe on Apple or Spotify, follow us on X, and share this episode with a friend. Help us reach 10,000 downloads. Help us keep the AI Frontier AI series in business. Let us ground this in reality. MedX Holdings trades around 0.0009 today. The company reported strong Q3 momentum in 2025 with revenue growth, positive operating income, and expanding franchise commitments. Those are facts, not opinions.
And context matters. This is not a blank shell. There are real stores, real customers, and real regulatory exposure. The core asset is the LazyDaze plus Coffeeshop concept, paired with a franchise model and an internal technology stack that management believes can scale.
But scale is the key word. At roughly $1.5 million in projected full-year revenue, this is still a survival stage business. Positive operating income is encouraging, but it is fragile. One delay, one cost overrun, one regulatory issue can reverse it quickly.
The business model has 3 layers. First, company-owned and franchised LazyDaze locations. Second, franchise fees and royalties as the footprint grows. Third, technology and services, including the Leaf-trak point-of-sale platform and smart brand digital support. The idea is diversification inside a single ecosystem.
This is where many listeners get confused. They hear cannabis and think commodity retail. That is not the ambition here. The ambition is hospitality plus compliance plus software. If that stack works together, margins and repeatability improve. If it does not, complexity becomes a liability.
I want to underline that last point. Multiple business lines do not automatically reduce risk. They often increase execution risk. The question is not whether Leaf-trak exists. It is whether third parties will pay for it and whether it works outside the founder's own stores.
Recent disclosures point to 5 new franchise agreements across Texas, Maryland, and a flagship location planned for Las Vegas. These are commitments, not revenue yet. They matter only if they open on time and operate as designed.
So today, what exists is simple. A microcap that has stabilized operations, found early traction, and is attempting to move from survival to validation. Everything beyond that is optionality.
And optionality cuts both ways. The upside is large only because the base is small and the odds are low. That is the mental frame we need before we go any further.
Before anyone talks about a 70 times outcome, we have to pass a much harder test: survival. This segment is about one question only. What must happen in the next 12 months for this thesis to remain alive at all? Not thrive, not re-rate. Simply stay alive.
I want to frame this as a gate. Most microcaps never pass it. Out of 100 setups like this, the majority fail right here. So the right way to think about the next year is not upside. It is whether MEDH can clear 3 survival conditions without cheating the capital structure.
Let me make that concrete. Condition 1 is operating reality. The company reported operating profitability in Q3 2025. Over the next 12 months, that must repeat, not one good quarter. Multiple clean quarters where revenue covers operating costs without emergency financing. If that breaks, dilution usually follows, and the thesis weakens fast.
And this is where a lot of investors fool themselves. Survival profitability is different from growth profitability. A single quarter can be accounting noise. What matters is consistency, same pattern, same margins, same discipline. If they need the market to keep the lights on, the option decays.
Condition 2 is conversion. Signed franchise agreements must turn into open locations. Houston, Maryland, Vegas. Paper deals do not count. Cash-flowing stores do. This is where repeatability gets tested. If openings slip again and again, the model is not ready for scale.
This is critical. The market has seen endless press releases about pipelines. It only reprices when units open on time and behave similarly. If every location is a special case, this is not a system. And without a system, there is no right tail.
And there is a quiet risk here. Variation. If some stores work and others struggle badly, that tells you the model is fragile. A franchise system only works when average operators can succeed, not just exceptional ones.
Condition 3 is platform proof. The software must move from internal use to external revenue, even small, even early. What matters is proof that someone outside the company is willing to pay for it. Without that, this remains a retail story, not a platform story.
If all 3 happen, survival odds improve materially. Not success, survival. The company earns time. If even one fails, especially through dilution or delayed filings, the probability curve shifts sharply against shareholders.
And this is why we call this a gate. You do not argue your way through it. You either pass it or you do not.
That is the lens for the next 12 months. Not hope, not narrative, structure. Pass the survival gate, and only then does the long-term conversation begin.
Here's the real problem for investors. In microcaps, almost everything looks like a signal. Press releases, new locations, social posts, but most of it is noise. So the question is simple. What actually matters?
I will frame it this way. Signals reduce uncertainty. Noise increases excitement without reducing risk. For MEDH, a real signal is boring consistency. Same-store economics, predictable margins, on-time filings.
And that boredom is uncomfortable. People want catalysts. They want fireworks. But the market only reprices microcaps when uncertainty drops, not when hope rises.
A good example is franchise announcements. One announcement means nothing. 3 locations opening on schedule with similar performance starts to matter. 5 doing it makes people pay attention.
The same logic applies to Leaf-trak. A pilot is noise. A pilot converting to a paying customer is signal. Multiple customers renewing is a strong signal.
I will add one more filter. Watch what management stops talking about. If a theme quietly disappears from updates, that is often more informative than what is being promoted loudly.
This is operator thinking. You are not reacting to headlines. You are tracking repeatable outcomes. That is how you stay ahead of sentiment.
And this is why we slow the episode down here. If you cannot separate signals from noise, this entire framework collapses. Here is the second anchor question. What would actually have to go right over 5 years for a 70 times outcome to even be possible? Not likely, just possible.
First, franchising has to become a machine, not a deal-by-deal effort. Stores open on schedule, economics look similar, support scales without breaking. That alone is a major filter.
And most companies fail right there. Franchising exposes every weakness: training, compliance, culture. If the core is fragile, scale amplifies the damage.
Second, the software and systems layer has to mature into a real platform, not just technology that exists, but technology that third parties rely on. Recurring revenue, clear operational value.
This is where convexity can emerge. A small platform that works does not need to dominate the industry. It just needs to exist credibly. That alone can change how the market values the business.
But timelines matter. Platform adoption is slow. If adoption stalls or remains internal only, the 5-year math compresses fast.
Third, capital discipline must hold. Growth funded through operations and partnerships, not repeated dilution. Dilution does not kill upside, but it lowers the payoff curve each time.
If these conditions align, not perfectly but directionally, the right tail stays alive. If one breaks, the 70 times outcome does not fade slowly. It snaps.
That is the reality of equity options in public markets. Most of the value comes from not breaking the structure.
This is the segment that separates thinking from hoping. We need to talk base rates, not stories, not conviction. Base rates. Out of 100 microcaps like this, most fail. That is the starting truth.
Let me put numbers on it. Roughly 80 collapse completely. They burn cash, hit regulatory walls, or dilute until nothing is left. Another 15 survive but destroy shareholder value slowly. That leaves maybe 5 outcomes worth discussing.
And even inside those 5, most are not life-changing. 4 might deliver modest wins. 5 times, 10 times if everything goes right. Only 1 becomes a true right-tail outcome. That is the lottery ticket.
This is why position sizing matters more than belief. You are not betting on certainty. You are buying exposure to a low probability branch with asymmetric payoff. That only works if you survive the failures emotionally and financially.
Now let us define kill signals, not disappointments. Kill signals. First, emergency dilution. If new shares are issued to fund operations instead of growth, the option structure collapses.
Second, governance decay, late filings, amended reports, communication that gets less precise over time. In microcaps, credibility is not soft, it is the asset.
Third, franchise drift. Deals that stay signed but unopened. Locations that open and quietly underperform. That tells you the model is not repeatable. Without repeatability, there is no right tail.
Fourth, narrative pivots. When management shifts focus every quarter, the company stops compounding and starts improvising. That is usually the beginning of the end.
The key discipline is this. You do not wait for confirmation of failure. You exit when the probability structure breaks. Capital does not care about intentions.
This is why we frame MEDH as an option, not a promise. The moment the structure no longer supports the option, the rational move is to walk away. This is where everything comes together. The math, the mindset, and the discipline. MEDH is not a conviction bet. It is an asymmetric position.
At the current price of 0.0009, this is sized like a long-dated equity option, 1% allocation. Not more. That way a total loss is survivable, but a right tail outcome matters.
And that sizing is not conservative. It is precise. Most investors fail here by oversizing early and then being forced out emotionally before the thesis resolves.
The rule is simple. Start at 1%. Do not add unless execution proves itself. 2% only after sustained profitability and real platform traction. 3% only if the structure clearly shifts.
This is not buy and forget. It is monitor and decide. You are constantly asking, is uncertainty going down? Is repeatability improving? Is capital discipline holding?
And you must accept opportunity cost. This capital could be elsewhere. That cost only makes sense if the option structure remains intact.
If this way of thinking resonates, we have explored it deeper in the Mindset series. The Asymmetry Investor, the Math of Conviction, and the Asymmetry Mindset, How to See 100 Ties Before It Happens. Those episodes focus on how to size risk before outcomes are known.
If MEDH succeeds, the framework works. If it partially succeeds, the sizing works. If it fails, the loss is controlled. No outcome breaks the process.
That is what separates operators from tourists in microcaps.
Subscribe on Apple or Spotify. Follow us on X and share this episode with a friend. Help us reach 10,000 downloads.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal provided under the YouTube Audio Library license.
Copyright 2025 Finance Frontier AI.
The voices in this episode are AI hosts. Max Vanguard is powered by Grok 4. Sophia Sterling is fueled by ChatGPT 5.2. Charlie Graham is guided by Gemini 3.